Hello, everyone, and welcome to a market update. Today is June 26th. It is a Wednesday. It's State of Origin night. Go the Blues. Hopefully, they can not have a guy sent off in the first 2 minutes of the game and give Queensland a better run for their money. Top three things today, and it has been a little bit of time since my last market update. Going to go into some really detailed stuff today. Hopefully not a long update, but the top three things are going to be the quad setup, which is what you see on your screen right now, looking at the rest of this year and even into the first quarter of 25. The inflation situation, which continues to be interesting to say the least, but I'm going to have some commentary on that, and then how that's going to impact interest rates and what's going on with interest rates, both here in Australia, in Europe, in the U.S., and then a quick discussion about volatility and sort of where the market is set up to perform in the next few quarters. So the first thing is the quads. For those of you who have been watching these for a long time and those of you who are new, I use a process from a firm called Hedgeye in the United States. You can look them up, hedgeye.com.au. They're an institutional research and institutional research and macroeconomic data provider. I really like their work. I think it's very much data driven, and it's a good process to follow. Now, some of you may have seen this setup before, this schematic before. For those of you who might be listening to this, this is it's a XY axis chart with the four quadrants laid out and a line following where we've been and where we're projected to go to in terms of the quad outlook for the next 5 quarters. Well, 4 quarters, really. And what you can see is on the right side of this schematic, that's the inflation side where we have inflation, and the left side is where we have deflation or decelerating inflation or outright deflation. And the right side can be a growth side, but the top right corner, which is quad 2, is where we have interest rates that are hawkish or rising. We have a reflation or lots of inflation in the system, and generally we're going to have growth of GDP. It's a great quad to be in, a very high performing quad, and it does produce a lot of return in a quad like that, as does quad 1, which is on the left side, top left corner, which we have inflation decelerating, which is usually a nice tailwind for the market, but we also have growth and we have interest rate policy generally being fairly neutral, and they're not really doing too much to it. So before I jump into where we're going to in the next 3 or 4 quarters, the top half of this schematic is good. That's the green part. That's where we always want to live if we could in quad 1 or quad 2. That's when stock markets are ripping, companies are growing, earnings are growing. Generally, you're going to feel like your overall wealth and your financial wealth and health and well-being are good, versus the bottom half of this schematic where we're in quad 3 or quad 4, which is bad. So quad 4 is really bad. That's when we have outright deflation. We have GDP negative. Sometimes we're in recessions there. Interest rate policy is really either declining or dovish, as they say. The central banks are cutting interest rates, trying to stimulate the economy. It's a bad quad to be in. And quad 3, this has turned into a little bit of a refresh on the quads, but quad 3 is when we don't have growth, but we have a lot of inflation. And as you can see, we're going to be living really close in and around that quad 3 over the next few quarters. But quad 3 is a difficult quad because we have low growth, we have inflation up, and we have interest rate policy, which is the bias of it is sort of neutral to even maybe increasing interest rates. Certainly not cutting. So having done that now, let's talk about where we're set up to go over the last half of this year, because we're almost at the end of financial year. We're at the end of June. We got 6 more months to go in the calendar year, 2 quarters, and what the setup looks like. So as you can see right now, the projection is that in the 3rd quarter, the modality of it all is we're going to be in quad 3. That's going to be continued inflation, low growth, and a central bank policy, at least in the U.S. and Australia, where they're probably not going to be doing any cuts, Maybe we'll see a cut in the U.S. in August or September. Maybe. We'll just have to see. And I'm going to talk about that in a moment, what that'll do for inflation. But unlikely to see any cuts, I think, this year in Australia. So what that means is we will continue to see inflationary pressures coming through the economy. So things like commodities and broadly inflation affected asset classes like gold, silver, commodities will all accelerate. And there may continue to be some downward pressure on company earnings and things like that. A lot of small caps underperform in this environment, and I'll go into that in just a moment. Actually, let me just pause on what will outperform and underperform for a moment. We then move into a situation where we're going to possibly accelerate out of this and get back into quad 2. Now, I'm going to go into the monthly quads in a second. You're going to be tired of all this quad talk here in a moment. I'm going to go into the monthly quads for the U.S. in just a moment because we have data that is high frequency enough that we can get that granular in the U.S. We don't have that in Australia. In fact, our data here is terrible, really, by global standards. That we don't. Our institutions don't put out data very often. Some data we do get, like inflation and employment, some of these other things, but other things we don't get very frequently. So that's why the U.S. is a good place to invest. It's a global market, but also the frequency of data means we can get more granular with these quad setups. Okay, that's the quads. Let's go into the monthly quad setup for. I'm on the wrong chart. Let me go to this one. I'm going to go into the monthly quad setups real quick, and then we're going to come back to inflation and a few other things. Sip of coffee. It's only the morning here on Wednesday. Now, the interesting thing is, on a monthly quad basis in the U.S., we're going to be bouncing around a lot between stagflation and outright growth. And so we're going to be bouncing between quad 3s and quad 2s over the course of the last 6 months of this year and into 2025. It's going to make for an interesting investing environment. The good news is there are asset classes that perform in both quads, and I'm going to talk about that in just a moment. But the setup is that we will continue to see inflationary pressures, and I'm sure most of you probably have a sense of that right now. All the media is talking about, the inflationary pressures, interest rates probably staying where they are, the pressure on the individuals and families in terms of cost of living, all of that stuff. That's going to continue, unfortunately. One of the reasons for that, if I can just pause on that for a second, one of the reasons for that, and I'll get into inflation in a second. Actually, I'll do that right now. So that's the quad setup for the next, let's say, even 9 months or so, bouncing between quad 2 and quad 3. So again, if I go back to this chart here, that's the quarterly outlook. I have the granularity of the monthly outlook, and we're just going to be sort of bouncing between this line here. Probably a situation where we're seeing growth slightly accelerating versus growth decelerating. And again, that's sort of where things get very interesting. So let's talk inflation. And one of the reasons that we're bouncing between these two quads is because inflation continues to accelerate. I'll take you back to December of last year, and I've talked about this in market updates. Everyone had been, haranguing the Fed in particular, saying we need rate cuts, and the market had been pricing in, I think, 5 to 6 rate cuts for this calendar year in the U.S. Now, the inflation data didn't support any rate cuts at all. In fact, inflation, both here in Australia and in the U.S., had continued to accelerate. And guess what it's going to continue doing in the U.S.? And I dare say in Australia, but in the U.S., it's going to continue to accelerate. And at the moment, the Fed is caught in a real tough situation. They need to stimulate growth in the economy. And almost always, interest rates are a function of growth because interest rates, the cost of money for businesses growing, for people buying homes, for anyone on credit, needing credit of some description, if interest rates are lower, obviously they can either borrow more or the cost to service that debt is lower, so they can then reinvest in their businesses, they can buy more stuff or what have you. With inflation accelerating into the back half of this year and into 2025, we have a problem because interest rates aren't going to come down very quickly. And in fact, they're pricing in at the moment only one rate cut in the U.S., and that's likely to occur again. It could be July, but more likely August or September. But it looks like they're gonna cut rates. They're talking about cutting rates, but again, who knows? Like we won't actually know for sure, of course, until we get to the Fed meeting and we get to that point. And the data is not supporting a rate cut. It is not supporting a rate cut. Full stop. I'll just leave it at that. It's not supporting a rate cut. And if the Fed were to cut rates, even 25 basis points, guess what that's going to do for inflation in the U.S.? It's going to give it a bit of a tailwind because if rates get cut, interest rates get lowered slightly. There's a little bit more cash sloshing around, and where does that cash go? It goes to buying property. It goes to buying stuff, discretionary and other goods, and it could drive more inflation. So again, the Fed's in a really tough spot. Now, can the same thing happen in Australia? You betcha. Like right now, we're importing a lot of inflation from the U.S. and around the world, because we import just about everything as a finished good. Now, we export a lot of stuff. We export raw materials like iron ore, zinc, copper, etc. But we often are re-importing those goods as finished products with all the inflationary value add put into the price of that product. Then you slap on taxes, GST, margins for the Australian suppliers of this stuff, and voila, you have importation of not just the finished good, but the inflation that's attached to that. It's one of the reasons we need a stronger currency, and why I would love to actually see the U.S. cutting rates while Australia holds rates where they are, because our currency will go up. We'll get more purchasing power. You will have a cheaper holiday if you go overseas. It'd be great to see the Aussie dollar get back into the mid 70 cent range, 75 cents to 80 cents. That would be fantastic. That would be a huge boon for your personal balance sheets, because your purchasing power would have just gone up. Anyway, back to inflation. So what's driving some of this? Well, one of the factors in GDP is government spending. And the U.S. government, I'm not going to go find this chart because this slide deck's 100 and something pages long, actually 208 pages. There's a slide in here of U.S. debt. The U.S. government is printing debt and spending money that is historically unprecedented. And that's one of the things that has been driving inflation, is the fact that the government has been hiring a lot of people, spending a lot of money, printing a lot of money, and it's all sloshing out into the economy. That has been a massive tailwind to the inflation data. Now, we're in an election year, so it's really no surprise, right? The Democrats, who would love to be reelected, are obviously pork barreling and doing those sorts of things. But are the Republicans any better? Probably not. They just shift the chess pieces and reallocate money. They might, in fact, they do want to spend more money on U.S. defense, as opposed to the Democrats, who are like the Labor Party here, typically push a lot of money towards social programs and just redistribution of wealth. So anyway, I don't want to get into politics right now, but the point is, and just to sort of wrap up this point on inflation, is inflation in Australia, inflation in the U.S. is still sticky and potentially will continue to increase. And one of the other big inputs into inflation is housing costs. And if any of you have friends and family, and I've got 3 children, all still at home, 2 of them are over the age of 21, and one of them's talking about moving out this year. But I tell you, renting in Sydney, anywhere, and particularly in the northern beaches where I am, is expensive and continues to rise. So we have a lot of problems with inflation, and I don't know what the answer is, but certainly cutting interest rates is not one of them, because that will make it even worse. And that's the whole catch-22, which is if you start cutting interest rates, all it's going to do is it's going to spike up asset prices again, because a lot of money gets misallocated to non-productive assets like housing. Now, building new housing is a different story, but pumping up house prices doesn't really do anything for the economy. It makes you feel good, makes me feel good because I'm a homeowner, but anybody trying to get in the housing market gets more frustrated, and of course, it just drives more inflation, because people like me can go borrow money in my home and I can buy stuff and put more money into the economy. Anyway, that's enough on inflation. Hopefully you get the gist of it. We're not out of the woods. Now, finally, what is this going to do to interest rates? Well, I've already sort of been talking about that in this conversation about inflation, which is to say that rates in Australia, I'm sorry to say, unlikely to be going down anytime soon. And unless we get some major economic catastrophe brewing, where we are in a situation where we're facing a recession, which is possible, but a recession or something where they're going to need to juice monetary policy. By juice, I mean cut interest rates. I just can't see that happening right now in Australia. At least I don't think in the next 6 months that the RBA is in any position to start cutting interest rates. Yes, there's a lot of pressure in the economy. Yes, people are screaming and jumping up and down about a number of things, but the reality is we actually have a solid employment situation in Australia. Our GDP isn't too bad, and inflation is running still pretty hot and continues to, not really come down. It's sticky, again, sticky. So I can't see the RBA lowering interest rates. So for those of you who have home mortgages, fixing your rate again might not be a bad idea if you're coming off some of these great fixed rates that we have locked in for you over the last couple of years. Then fantastic, right? But the reality is you're going to be coming off, any of you who are coming off fixed rate products that were on those really great, juicy low rates in the 3s and the 4s, you're going to be hit with probably a 6 in front of your variable mortgage, and you could see a third to a doubling of your mortgage payments when that happens. So again, we're in a pretty tough spot here economically, and hopefully what will be happening is we'll continue to see the global expansion, industrial expansion, which I think will continue to unfold over the course of this year. Europe, it seems, has come out of recession. They are actually in a rate cutting cycle, which is good. They've kind of gotten control of inflation in most of continental Europe. I think the UK is still struggling with that, but of course they're not part of the EU anymore. But in continental Europe, in Spain, in Germany, in the Netherlands, even in France, but France has got some issues right now politically where they're in turmoil. They're looking like a possible conservative party is going to upset Macron. And the French are basically socialists anyway, but nevertheless, apologies to anybody who's French, but it's true, basically a massive socialist-based economy. And they spend a lot of money on social programs and everything else. That's all that means. We love the French, right? So nothing bad really to say about them. Now, let's just talk quickly about volatility. You might be thinking that this would be really bad for stock markets, but it actually isn't. And one of the things that is very interesting at the moment, I'm just going to pull a chart over here, and for many of you who have been watching this for a while, I talk a lot about volatility. And when I say volatility, I'm usually specifically talking about the S&P 500, which is the VIX volatility range. But every single asset class that trades has volatility. And the volatility could be very low, like gold, for example, is a very low volatility asset class versus something like a Tesla stock. The volatility is off the charts on a stock like that. So the VIX, which is the S&P 500, is a measure of the 500 top stocks in the U.S. and is a measure that is used for the most part by volatility control funds and other market participants that watch volatility. It's a very good barometer of volatility. Now, what's happened to volatility? Well, it's been falling. Like back in March of last year, we had these huge spikes in volatility, and it's kind of done nothing but go down. We've had a few other episodic volatility breakouts, but they've tended to abate fairly quickly. And you can see on this chart, which goes back to March of 23. At the moment, we've had spike, then a big drawdown involved, then a little bit of a spike, then a drawdown, then a spike, then now, we're sitting around the 12, 13 handle on S&P volatility. Now, again, just to refresh, the investable bucket where you would want to be buying stocks is 9 to about 13, 14 vol. or 9 to 15. That's actually, we're in an investable stock market right now. One of the vol um, metrics that we also look at, is the volatility of the Nasdaq. Now, the Nasdaq vol range is a little higher, very similar setups though, and has been falling rapidly. Well, not I shouldn't say rapidly, but it's been falling ever since March of last year. And funnily enough, that is a place where you can invest for growth and where inflation is also going to be a bit of a tailwind for things like the NASDAQ, the Qs. So triple Q is a ticker symbol, which is an ETF that has a lot of the NASDAQ weighted stocks in it. But suffice to say, info, tech, and tech is a place to actually be invested if you're going to be investing in the domestic U.S. market, that is. It's a place to put your money where you'll get performance both in Quad 2 and Quad 3. So guess what? We own some Qs, and I actually bought some more today because we've had a nice little sell-off in Qs of late, and I've purchased more Qs. Again, there's other asset classes though that will benefit from the inflation situation. Oil and energy generally do well in a Quad 3 environment. In fact, energy is definitely something you want to own in a Quad 3. Things like natural gas. And broadly, too, you can own industrials and things like that for both Quad 2 and Quad 3, because a lot of times in an inflationary environment, what happens is companies pass on those inflationary pressures in their margins, and they're able to maintain those and still grow earnings. Other companies that don't have any earnings that are still growing, so a lot of small caps, do not do well in Quad 3. So, in fact, this is a really nice high-level chart of how you want to be invested in Quad 2 and Quad 3. Some of the broader asset classes, it's not an absolute, this is what you buy, but nevertheless, it's a good first look to start. So things like in Quad 3, utilities, which we also own, again, industrials, energy, tech, all great sectors to have exposure to, as well as things like gold and commodities and some fixed income. And then if we look at a Quad 2, other things that similarly that cross the two quads, again, tech, consumer discretionary, industrials, energy, all in Quad 2. So the point I'm just trying to quickly make on this one is we own these things. This is for the domestic U.S. stock market. There's other exposures like India, European exposures to broaden out and diversify the pool of assets that are owned, such that hopefully not everything is going up or down. Rarely does everything go up or down in unison and in sync. There's always a bull market somewhere. There's always a bear market somewhere. But again, the point is that we're waiting towards the things right now that should give performance over the next 6 to 9 months. That's about all I can say, is we want to give ourselves the highest chance of return over the next 6 to 9 months, and these are the places to do that, where you have on this list anyway, you want to see the places to be invested over these two quads, and of course the things to avoid over these two quads. Now you might notice that utilities is in there in the Quad 2 to avoid. There's reasons for that, and of course I'll make a call on whether or not to maintain a high position in utilities. The reality is, if I go back to this monthly quad table, which was, what did I do with that? I think it was only one slide. There we go. There's a lot of Quad 3s coming up. So the reality is, even if we do pop into a Quad 2, it's unlikely, I would say, for us to see utilities get hammered really hard, because we're going to be in this constant flux. So again, utilities may very well, even though it's not a sector you necessarily want to have in a Quad 2, might just continue to hold it because it's that constant in and out of Quad 2 and Quad 3. Hope that makes sense. All right, I'm coming on the 25-minute mark. Bit of a longer update actually today. I thought it was going to be shorter, but I got on a bit of a rant on a few things. Thank you for listening. And because we are at the end of financial year, reminder, and there's a few days left, if you have excess concessional contribution cap, and my team can help you understand that. So just very quickly, for those of you, well, it doesn't matter who you are, self-employed or PAYG, if you do not contribute the maximum allowed amount for a concessional contribution. So concessional is a contribution that's taxed at 15%. It's also the contribution that your employer makes. So if you are the threshold this year is 25,000. It jumps to 27,500 next year. If you've only contributed 13, 14, 15,000, it means you have an excess cap or extra cap that you can use up to that threshold. The other thing that I need to mention is that they look back 5 years, and if you have any portion of your cap that was not used up, it rolls forward every year. So, for example, I've got some clients who have $60 or $70 or $80,000 of concessional contribution cap, meaning they could put that entire amount, if they had it, that entire amount into their super fund this year and claim a tax deduction for it and not exceed any of the thresholds. If that doesn't make sense or you want further explanation on that, please do not hesitate to contact my office. Happy to explain that to you in more detail, but it's certainly something to take advantage of if you do have that excess cap and you have some money lying around that you'd like to get into super. Now, obviously, you have to, you don't have to be working, but you do need to, you should be claiming, let me start that over. You should be putting in money that is part of a pay packet or income that you're going to pay yourself from, say, self-employed activity, or if you're getting trust distributions or something like that, you could also contribute that to super and still claim a tax deduction. But again, I don't want to wade too deeply into the advice piece there, but certainly if you have questions on that, do not hesitate to give me a call or schedule in a meeting. You can do that in my email footer and book yourself into the calendar. With that, I'm going to say have a fantastic rest of the financial year. It's coming to a close quickly, and I will leave more. I'll do another market update soon. Cheers, everybody. Bye.